So maybe you've heard the buzz about private equity, right? Like it's this exclusive club where fortunes are made, low risk, high rewards, all that jazz. Tony Robbins even talks about it. And who doesn't love a good Tony Robbins pep talk?
Yeah.
But let's be real for a second. Sometimes when something sounds too good to be true, it's time to, dive in a little deeper.
And that's exactly what we're here to do, separate the hype from reality. Because private equity, it's not like playing the stock market, not even close. It's a whole different ballgame, more like navigating a maze than strolling down Wall Street.
Okay, so less about checking your portfolio every 5 seconds and more about playing the long game.
Exactly. Think of it this way. You're investing in companies that aren't publicly traded. They operate under the radar, away from all the stock market frenzy.
Interesting. So it's all about strategy then, long-term vision.
Absolutely. And within this world of private equity, you have different players, each with their own playbook. You've got your venture capitalists, the bold ones. They bet on startups, the ones with that make it or break it energy.
So kind of like the gamblers of the financial world. High risk, high reward.
Well, they're more like talent scouts, always on the lookout for the next big thing. Then you have the growth capital investors. They come in later when a company's more established, needs a boost to expand, maybe conquer a new market.
The strategists making sure those businesses reach their full potential.
Exactly. They're all about scaling up. And then, of course, you have the leveraged buyout specialists, the LBOs, the ones who make headlines with those massive acquisitions.
Ah, yes, the LBOs, using debt to buy companies, right. Didn't we read something about that? Like someone taking out a huge mortgage on a mansion, hoping the price goes through the roof. Only here, we're not talking about houses, we're talking about entire businesses. Is that where the low risk idea starts to fall apart a bit?
You're spot on with that analogy. Just like buying a mansion with a huge mortgage, using debt, or leverage as it's called in the finance world, well, it can be a double-edged sword. It can amplify your gains, sure, but it can also magnify your losses. Now, you're right, private equity has had a pretty impressive track record when it comes to returns, often outperforming the stock market.
We saw some numbers on that, right? 14% returns compared to the S&P 500 at, what was it?
Yeah, our research showed private equity averaged 14.2% over a 35-year period, while the S&P 500 came in at 9.9%.
Yeah.
But, and this is a big but, that gap, it's been shrinking.
Shrinking. So the private equity gold rush is losing its shine. What's causing that?
Well, a few things are happening. One, the private equity scene is getting crowded, a lot more competition these days, more firms, all chasing the same deals. It pushes prices up, and that can eat into those impressive returns. It's like anything else, supply and demand, right?
Yeah.
The more buyers you have going after a limited number of things, the pricier those things become. And then there's the issue of those tax advantages. Remember, we talked about those.
Right, the perks of being in the exclusive club.
Well, there have been some recent tax reforms, and they've chipped away at some of those benefits. So the game, it's not as lucrative as it used to be.
So it's not as easy as just looking at those past returns and assuming the good times will last forever.
Exactly. Past performance, never a guarantee, especially in a world as unpredictable as finance. Which brings us back to the risks involved, especially with those leverage-heavy LBOs. It's like this, imagine a private equity firm buys a company for, say, $1 billion. But 800 million of that? Borrowed money.
A massive loan.
Right. Now, if that company's performance even dips a little, things can go south really quickly. Those interest payments on all that debt, they can be crippling.
Okay, yeah, that's a lot of pressure. And we can't forget about the illiquidity issue, right? It's not like the stock market where you can buy and sell with a few taps on your phone. Private equity, that's a long-term commitment, isn't it?
Absolutely. You're essentially locking your money up for years, could be 5, could be 10. It's not for the impatient investor or someone who might need to access their cash in a hurry.
Definitely a high-stakes game, and not one for those who like to play it safe. We've talked about the leverage, the illiquidity, and then there's also the issue of transparency, or rather the lack of it. From our research, it seems like private companies, they aren't held to the same standards of reporting as publicly traded companies. So how does an investor even begin to assess the risks?
You've hit on a really important point. It's a significant risk factor. With public companies, you have quarterly reports, financial statements, all sorts of data at your fingertips. It's like having a detailed roadmap to guide your investment decisions.
But with private companies,
It's a different story. You're often left in the dark. Limited information makes it a lot harder to get a handle on the company's financial health, let alone evaluate potential risks.
so we've got these high stakes, lots of leverage, long-term commitments, not a lot of transparency. It's starting to sound like venturing into the Wild West of finance out there.
Oh, it's definitely not for the faint of heart. But hey, there's a reason private equity still attracts investors, right?
Huh.
And a big part of that is those potential tax advantages we mentioned before.
Right, those perks of being in the exclusive club. But how does that actually work in real life?
Well, one strategy that's used a lot and often raises eyebrows, it's the way they handle interest on all that debt financing.
We were just talking about that, all the debt from those LBOs.
Exactly. So private equity firms, they can actually deduct those interest payments on that debt, which reduces their overall tax burden.
Wait, so they're getting a tax break on the very debt they use to buy these companies? Doesn't seem quite fair, does it?
It's totally legal. And to be fair, this kind of strategy is used in different ways across all sorts of industries. But you're right. In the private equity world, with the sheer amount of debt involved, it definitely raises some questions.
Makes a bit of controversy.
Yeah. Some people say it's just a smart way to encourage investment, gets the economy moving. But then others, they see it as this unfair advantage, like it's tilting the playing field.
A tale of two perspectives, I guess. Okay, so we've covered a lot of ground here. The potential, the pitfalls, the rewards, the risks. But let's be blunt. Is private equity something the average person should even consider? Should we all be calling our financial advisors tomorrow, demanding a piece of this pie?
Well, after everything we've discussed today, I think it's safe to say it's not that straightforward. Look, private equity can be a really valuable tool, but it's usually best suited for certain types of investors, like institutions that have a really long-term outlook and high tolerance for risk.
They're in it for the long haul.
Exactly. But for the average person, especially anyone who values flexibility or who might need access to their money sooner rather than later, well, there are probably other options that make more sense.
Makes sense. So if someone's listening, feeling that pull towards high growth potential, but maybe not quite ready to dive into the deep end of private equity, what would you suggest?
You know, our research actually pointed to a pretty interesting alternative. Small cap equity index funds. They track the performance of smaller companies. And just like those private equity targets we've been talking about, these companies often have a lot of potential for growth.
So you get the growth potential, but without all the baggage.
Exactly. And you get the added benefits of diversification, more transparency, and crucially, that liquidity we talked about.
Yeah.
That's something you often don't get with direct private equity investments.
That's a great point. Well, we've certainly journeyed through the exciting, often complicated world of private equity today, but one thing's for sure. Things are changing, with returns shrinking and more scrutiny on those tax practices, not to mention these other investment options popping up. It really makes you wonder, what does the future hold for this exclusive club? Will we see more transparency, maybe more opportunities for everyday investors? Or will private equity always remain the realm of Wall Street giants? Something for all of us to think about. And hey, maybe a topic for another deep dive sometime.